Silver prices have pulled back sharply, leaving many investors wondering, is this a warning sign, or could it be one of the biggest buying opportunities in years? Throughout history, major corrections in precious metals have often created opportunities for long-term investors. While short-term price drops can trigger fear and uncertainty, experienced investors know that market pullbacks sometimes occur even when the long-term fundamentals remain strong. Silver occupies a unique position in the global economy. Not only is it a precious metal used for wealth preservation, but it is also an essential industrial metal powering solar energy, electric vehicles, semiconductors, artificial intelligence infrastructure, medical technology, and advanced electronics. As industrial demand continues to grow, many analysts are closely monitoring whether the recent price decline reflects temporary market sentiment or a deeper shift. In this video, you will discover why silver prices recently fell, the key factors driving market volatility, and whether industrial demand remains strong. We will explore how supply shortages impact future prices, what history tells us about corrections, and the bullish and bearish cases investors should consider. Some investors see panic, others see opportunity. The biggest question is whether today's lower prices could represent an attractive entry point for long-term investors. Could this correction become one of the most talked about buying opportunities of the decade? To answer that, we have to look past the noise. When you stare at a screen flashing red, human psychology instinctively pushes you toward fear. It is natural to feel anxious when assets drop sharply. However, true wealth in commodities is rarely built by reacting to sudden emotional impulses. It is built by understanding deep mechanics of supply and demand. We are living in an era of unprecedented technological acceleration. The world is trying to rebuild its entire energy grid while constructing massive data centers. Both of these monumental human endeavors require silver, lots of it. Yet, price action often ignores these physical realities. The market reacts instead to obscure derivatives, algorithm trading, and shifting central bank policies. We must separate paper illusions from physical realities. We will break down how commodities exchanges operate, why they pull the rug out from retail investors, and how you can use this to your advantage. To understand where silver is going in the next 5 to 10 years, you must look at the mines, the tech companies, and the macroeconomic forces. Watch until the end for our comprehensive market analysis, historical context, and the absolute latest developments shaping the global silver market today. To understand the magnitude of this opportunity, we must first deeply dissect the trauma of the recent price action. Silver does not do anything quietly. It is historically known as the devil's metal because of its intense volatility. The metal began the year 2026, trading around $71 per ounce, driven by industrial demand and geopolitical fears. It surged past $110, eventually hitting an all-time high near $121.67 in January. On January 30th, silver suffered one of its largest single-day drops, falling roughly 30% in a matter of hours. In June, it fell another nearly 6%, breaking back down below the $70 mark to rest around $67.30. But why did this happen? Did the world suddenly stop needing silver? Did massive new mines suddenly flood the market? Absolutely not. The trigger was not a sudden abundance of physical silver. The crash was entirely engineered by paper market mechanics. On exchanges like the COMEX, traders buy and sell contracts representing silver rather than the physical metal itself. They use leverage called margin. When the price skyrocketed, the CME group stepped in and raised the margin requirements, demanding traders put up significantly more cash. For smaller speculators and highly leveraged hedge funds, it is catastrophic. When they cannot meet requirements, brokers forcefully sell their silver contracts. This creates a cascading avalanche of selling. One forced liquidation triggers another, pushing the price lower, triggering even more margin calls. Combine this with a hot United States jobs report in May, which sent the probability of a Fed interest rate hike soaring. Higher interest rates typically strengthen the United States dollar. Since silver is priced in dollars, a stronger dollar pushes silver down. Algorithmic trading bots read the jobs data, saw the dollar rising, and immediately began shorting precious metals. The global silver market is a fraction of the gold market, meaning small flows of capital can move the price violently in either direction. What we witnessed was a classic positioning unwind. It wiped out billions in paper profits, shaking the weak hands out of the market. Meanwhile, sovereign wealth funds and central banks used the suppressed price to accumulate the discounted physical metal. They bought the panic. In the face of artificial suppression, the smart money stayed focused on the physical asset. They saw the value while others saw the price. If the paper market is flashing red with panic, the physical market is screaming green with unprecedented demand. Let us shift our focus to the real world, the industrial applications that now account for roughly 60% of global silver consumption. First, Consider the green energy transition, which is arguably the largest infrastructure project in human history. Solar photovoltaics alone grew from 11% of silver's total industrial demand a decade ago to nearly 30% today. The solar industry is actively transitioning from older PERC battery technologies to advanced N-type batteries, specifically TOPCon and heterojunction technologies. Why does this matter? Because these new highly efficient solar cells require significantly more silver paste per unit of power. Manufacturing advances have not reduced silver's role in solar. They have amplified it because silver is the most electrically conductive metal on the planet. You cannot cheat the laws of physics. Second, we find ourselves in the early innings of a massive artificial intelligence infrastructure build-out. High-performance computing chips possess power consumption profiles exceeding 1,000 watts per chip. This generates immense hardware melting heat. To keep these processors safe, the industry requires unprecedented amounts of silver-based thermal interface materials and hyper-precision connectors. Furthermore, every electric vehicle rolling off an assembly line requires nearly double the amount of silver compared to a traditional engine vehicle. It is used in battery management systems, navigation screens, autonomous sensors, and heavy-duty switches handling high-voltage currents. For every single mega data center built, tens of thousands of ounces of silver permanently disappear from the circulating market. Unlike gold, which is hoarded in vaults, silver used in these microscopic technological applications is consumed. It is spread so thin across billions of circuit boards and smartphones that it is incredibly difficult and economically unviable to recycle. When that silver goes into an artificial intelligence server rack, it is effectively gone forever. The industrial squeeze is not a future theory, it is a present reality. At this point, logic dictates a very simple question. If industrial demand is so incredibly high and we are facing a shortage, why do not the mining companies simply dig more silver out of the ground to meet the demand? The answer lies in a vital economic concept known as supply inelasticity. Approximately 70 to 80% of all silver produced globally is not actually mined from dedicated primary silver mines. Instead, it is extracted as a byproduct of base metal mining, specifically from the mining of copper, lead, zinc, and gold. This creates a fascinating and dangerous dynamic. The global supply of silver is largely deaf to the price of silver itself. If the price of silver suddenly doubles or triples tomorrow, a copper miner is not going to spend $1 billion and wait 10 years to open a massive new copper mine just to get the tiny fractional byproduct of silver. Their business is copper. Unless copper prices also skyrocket, that new silver will remain buried in the earth. According to data from Metals Focus and the Silver Institute, the year 2026 marks the 6th consecutive year of a global physical silver supply deficit. We are literally consuming more than we are pulling out of the ground, running a structural shortfall of tens of millions of ounces annually. How is the world surviving this deficit? By draining the above-ground inventories. Over the last few years, we have seen massive drawdowns in the vaults of the COMEX in New York and the London Bullion Market Association. But those vaults are finite. They are not bottomless pits. Furthermore, the primary silver mines that do exist, located primarily in countries like Mexico and Peru, are suffering from declining ore grades. Miners have to dig deeper, process more dirts, and spend more on diesel fuel and labor just to extract the same amount of silver. Add in tightening environmental regulations and local geopolitical unrest, and it becomes clear that the market has absolutely no fast mechanism to produce more physical metal when industrial demand spikes. The supply is strictly capped. To truly understand if this current crash represents the buying opportunity of the decade, we must look backward at history. The biggest single-day crashes almost always happen inside secular bull markets, not at the end of them. In the world of precious metals, extreme volatility is simply the price of admission. Let us compare the environment of 2026 to two famous historical periods, the 1970s and the year 2011. In 2011, silver experienced a legendary run, nearly touching $50 an ounce, before suffering a devastating crash down into the teens. That crash occurred because the fundamental macroeconomic environment violently shifted. The Federal Reserve was preparing to tighten monetary policy, real interest rates were rising, and the massive quantitative easing response to the 2008 Great Financial Crisis was being unwound. The tailwinds that drove silver up were suddenly dead. The 2026 crash looks mechanically similar on a chart, driven by margin hikes and forced speculative liquidations, but the macro environment is the exact opposite of 2011. Today, we are not looking at a world turning off the money printers forever. We are looking at structural, irreversible physical supply deficits. We are looking at explosive technological demand that did not even exist a decade ago. When we look back at the 1970s, silver had multiple massive corrections of 20 to 30% during its legendary climb from under $2 to nearly $50 by 1980. Every single one of those terrifying drops was a final chance to board the train before the next major leg up. The sharp swings we are seeing today are driven by futures market positioning, algorithmic trading, and short-term panic, not a sudden destruction of the metal's long-term utility or miraculous discovery of new global supplies. So, what is the final verdict? As objective investors, we must lay out both the bear and the bull cases clearly. The bear case relies heavily on the threat of a severe, prolonged global recession, because silver is a highly industrial asset. A massive economic contraction that halts solar panel deployment, slows data center construction, and stops electric vehicle manufacturing could temporarily crush demand. Furthermore, if the Federal Reserve is forced to hold interest rates much higher for much longer due to sticky, uncontrollable inflation, the persistently strong United States dollar will continue to act as a heavy headwind against precious metals, potentially pushing paper prices lower in the short term. The bull case, however, is rooted in undeniable hard mathematics. We are looking at 6 consecutive years of compounding physical deficits. We have rising, inelastic industrial demand from modern sectors that simply cannot substitute silver with cheaper metals without suffering unacceptable losses in performance. We have massive geopolitical uncertainty, de-dollarization trends, and central banks hoarding gold at record paces, which historically always drags silver higher as the ultimate hard money alternative for the masses. Silver, sitting between $65 and $75 today, is still vastly outperforming its long-term historical averages. A 30% haircut from all-time highs is terrifying if you bought at the absolute top. But for the patient, educated investor, this is exactly what a healthy, deep correction looks like in an ongoing commodity supercycle. If you believe that the future of humanity will require more electricity, more solar power, more electric vehicles, and vastly smarter artificial intelligence, then the one specific metal powering all of it is currently sitting on sale. This might not just be a fleeting buying opportunity. It could very well be the final time we see these price levels before the compounding industrial deficits completely and irreversibly drain the remaining global vaults. Thank you for taking the time to watch, and make sure to subscribe and turn on notifications for more deep dive market analysis.